Good morning, friends. Hope you all are doing well. Today I am going to discuss about the concept of risk and return in financial management, and you can consider this information in your practical life of investment, wherein you can consider how the risk is measured and what is the relationship and trade-off between risk and return. So, in financial management, risk is nothing but simply a chance of losing money, while the return is the gain from the investment. So, there is a direct relationship between the risk and return, which is called risk return trade off. Meaning, thereby is where there is a high risk, there will be a higher return, and lower risk investment typically offer you, provide you the lower return. And financial manager across the globe analyze the risk and return to balance the investment objective with risk tolerance, and they optimize the firm or individual portfolio by by spreading the investment, means making the portfolio of the investment across the different asset class in order to minimize the overall risk of an investment. So, in investment, particularly, there are a lot of theories given by the prominent economists like Markowitz, Saab, Trainer. They all were discussing, they all were discussed about the return and the risk, and how the risk and return can be trade off, and how the maximum return can be earned with a optimum level of risk. So now come to the concept called risk. Risk is basically uncertainty surrounding the actual return of an investment will generate and probability of losing money. Simply speaking, when there is a tendency to losing the money, so this situation is called risk. And the risk can be of various reasons, like it could be because of legal risk, operational risk, industry risk, risk due to currency movement called foreign exchange risk. And the question is how to measure the risk. Is there any tool basis on that the risk can be measured? So there is a statistical tool exists in the financial management. With the help of that tool, the risk can be measured, and the tool is called standard deviation. And standard deviation basically indicate how an investment return is vary from its expected value. When there is a large deviation, when there is a more deviation, it's simply reflect that there is a greater amount of risk. On the other hand, when the standard deviation is at lower side, it signify that the risk in an investment portfolio is lower side. Now we talk about concept of return. Return is basically the income or the gain an investor receive from its investment by making investment in different portfolio or different investment assets is called return. Return can be in the form of interest, it can be in the form of dividend, or it can be capital gain or appreciation in the value of the asset. How the return is related to the risk, or what is the relationship between risk and return? The potential return is often proportionate to the risk involvement. Means if we take more risk, then there is a tendency to have or to earn more return, or vice versa. Third is risk free rate. The risk free rate is the theoretical return on an investment with zero risk, like government bonds, treasury bills, debentures. Here, they offer basically a guaranteed risk free rate of return. Therefore, the risk element in such kind of investment is zero. So, risky investments must offer you the greater return as compared to the risk free return. So, therefore, when there is a risk element becomes more, and an investor, while taking the extra risk, he expect the more return. So therefore this theory higher the risk, higher the return, lower the risk, lower return prevails across the globe. So, my dear friends, this was all about the return and risk relationship and its trade off. A vigilant or a rational investor always, while making investment in any assets, he should always trade off between the risk and return. As per the risk appetite of the investor, he should invest in the assets, and if he is more interested in fixed kind of return, so he should go for risk free rate of return like treasury bills, bonds, and debentures. He should invest in these kind of assets. Whereas is the risk appetite of an investor is more, if he is ready to take more risk, so he must basically invest in risky assets like equity and futures and options and investment assets like these. So hope, my dear friends, I would have given you the basic idea about how the risk and return works in the real life and how the trade off can be made. So, whenever you want to make any kind of investment, particularly in the stock market, so you should take the assistance and help of a good consultant or insurance or business investment advisor, so that he would be able to help you to make the trade off between the risk and return, so that your return would be more in future with a given level of risk. So with this, I close my topic for the day, and tomorrow I will be coming with a new concept of the finance. Till then, stay blessed, good health. Thank you very much, friends.